We're joined now by Stephen Carroll, our business editor. Hello there, Stephen.
Hi, Catherine.
And we're going to start off with one of the best-known companies in the world, Facebook. Now, they've had some pretty mega results, but there's still some disappointment.
So on the face of it, the social network's figures were very impressive. Its profits jumped by 166% in the 3 months from July to September. But a comment from its financial chief that growth in earnings would slow down next year sent the company's shares tumbling in after-hours trading. The 7% slump knocked more than $20 billion off Facebook's value. Martin Pollard has more.
The world's second biggest internet company keeps getting bigger and more profitable. Between July and September, the social network earned profits of $2.4 billion. That's up 166% from the same period last year. In total, Facebook took in over $7 billion in revenues, up over 50%. And more of that revenue is coming from mobiles. It now accounts for 84% of its advertising sales. Profits are being helped by a continued increase in the company's user base, led by the Asia-Pacific market. Facebook now has 1.8 billion active users.
We're really pleased at the strong growth of the Facebook community. That's pretty exciting to us.
But there was some cause for caution. In a conference call with investors, Facebook's chief financial officer said growth would slow meaningfully next year. That's because it has reached the maximum number of ads it can show in users' news feeds. Shares in Facebook fell by 7% in after-hours trading following this announcement. The social network plans to focus more on video ad revenue on mobiles in future. It can also look to increase advertising on 2 other apps it owns: Instagram and WhatsApp, which also have a growing user base.
We're going to turn now to Egypt, where the central bank has announced some rather big changes for their currency.
The bank says it's to allow the Egyptian pound to float freely on the market. It's a massive change for a currency that's been pegged to the dollar for more than a decade. It's been trading at a record low on the black market for months as the country came close to running out of foreign exchange reserves. The central bank also raised interest rates by 300 basis points. The measures move Egypt closer to securing a $12 billion loan from the International Monetary Fund.
All right, let's get an update then on the latest market action.
We've got European shares opening down again today. Good news, though, for the luxury goods maker Hermès. Their shares up by almost 2% at the open in Paris after their results. Less good news for the bank Credit Suisse. Their shares down almost 4%, despite reporting a surprise profit in the third quarter. That's the picture there at the open in Europe. On the Asian market, still seeing some concern over the American elections playing into trading in Asia. We had seen falls earlier on all of the Asian markets, but we had seen Shanghai and the Kospi in Seoul turn into positive territory as the day went on. The Nikkei in Tokyo is closed, though, for a holiday. Some more of the day's business headlines for you next. Air France-KLM is to launch a new low-cost airline on long-haul and medium-haul routes. The announcement made part of the Trust Together strategic plan for the airline, which forecasts annual growth of 2 to 3% in long-haul passengers until 2020. The plan also involves cutting another 1.5% in costs. Shares, though, opening down in Paris. Wearable technology maker Fitbit has lost a third of its value after warning of lower than expected sales in the run-up to Christmas. The company disappointed investors by estimating sales of up to $750 million for the last 3 months of the year. In the past 3 months, its sales have risen by 11%. And the French bank Société Générale has beaten expectations with profits of €1.1 billion for the 3 months to the end of September. The group's investment bank was the star performer, earnings there up 42%, but income at its French retail bank fell by 15%.
Just time for one final business story then, and the impact of Britain's vote to leave the European Union. Apparently, it's now being felt on Europe's ski slopes.
Resorts in France, Switzerland and Austria are all reporting a fall in bookings from British customers. Of course, that's due to the weaker pound after the Brexit vote, is making those trips much more expensive for people from the UK travelling abroad. Bloomberg estimating that bookings are down by as much as 10% in some resorts. So a big hit for places like Chamonix that are expecting lots of British tourists normally as the winter season rolls around.
Indeed, and it's not a cheap holiday anyway, is it, skiing? All right, thanks so much. Stephen Carroll, our business editor here on France 24.